Hi there, welcome back to First Trace. 10,588 on the index. You've got the broader end of the market, which is continuing to flex its muscles after yesterday's outperformance. That continues today. More importantly, the Dow Jones has pared off its losses. That's what the Dow futures are indicating. So we've snapped that 7-day losing streak. But let's get in some big voices, global voices on the Indian markets and emerging markets as a whole. Let's hear our Koch, Head of Equities Client Portfolio Management at Goldman Sachs Asset Management, talking about India, the emerging markets pack, and whether or not there's an upside despite the run-up in valuations. Listen in.
The Indian equity markets, let's talk about that because, that's core to your overall EM strategy as well. How do you look at Indian equities compared to EM equities in the current market environment? Because, last year was such a fantastic year. It was like a rising tide lifting all boats, so everything went up. Yeah. But do you think that there's still more upside given where valuations are? India in the context of EMs and EMs in general?
Yeah, so for foreign investors, when they look at emerging markets, let's start there, they're getting about 2 times the earnings growth at a 25 to 30% discount than what's on offer for in U.S. equity markets, right? So EM at a headline level looks more attractive to the U.S., more earnings growth, and you get to pay less for it. So that looks quite attractive. And then within emerging markets itself, India actually is one of our favorite places to allocate capital. Now, I do think that India has the capability of outperforming many other emerging markets, but our overweight we built up more at the company by company level, because one of the great things about the Indian equity market as an equity investor is the diversity of the market, that there are so many privately run companies. So we try and avoid state-owned enterprises, and this market has less state-owned enterprises than China, for example, so many privately owned companies and great diversity across a lot of different sectors. And so when we're building our portfolio company by company and going down in the market capitalization, India is the place where we find the most idiosyncratic and interesting opportunities, and that leads us to be overweight India in the portfolio.
You know what fascinates me the most is that you have $4 billion parked in small caps and mid caps in India. Yeah. Right, where we've seen a fair amount of unwinding over the last few weeks, but they have done well against the benchmark. Right. They've done well against the large caps, right? Is the conviction likely to take you to extend your allocation to large caps as well, or do you think that India is a small cap, mid cap treasure house?
Right. So we do always invest across the market cap spectrum. So we do have some large cap companies, but we are overweight the small and mid cap companies relative to most of the major benchmarks. And I would say that we've been able to generate outperformance when small and mid caps have been in the lead, and we've also been able to generate outperformance when they've been behind. So really the track record that our team has built, led by Hiran Dasani, is really built through the stock selection that's been persistent through different market environments and through capitalization of the market taking different leads. As it relates to your question, are we going to change that? No, I think we're still going to run a balanced portfolio with a bias towards those small and mid-cap companies because they're less covered by the sell side. People are just not as aware of those opportunities, which means there's more inefficiency there, more opportunity for alpha generation. And we tend to be able to find more of these companies linked to the story we're most excited about in India, which is the rise of the middle-class consumer.
So is consumption your large play?
Yeah, we definitely have a lot of links in the portfolio to consumption and related sectors to the consumer, like education and healthcare, for example. We do have some exposure to infrastructure build through the materials sector, but I would say our largest play in the portfolio is through consumer and consumer-linked stories.
Right, and that's important because, the focus for India has been consumption for a very long time. Yeah. But now, attention is being laid on how the next leg of growth will come in through the investment-led cycle, right? Which is infrastructure, essentially. And most of your clients have been talking about that. You said that your clients are very keen. You, in fact, met the Maharashtra Chief Minister as well in this regard to talk about. I mean, look at Mumbai, right? It's all dug up. Hopefully, by the next time you come into the city, it'll be, a lot more developed in terms of infrastructure. But you think that's a big theme?
Yeah, across all of India, and certainly what we heard from the Chief Minister of Maharashtra today is that there's a big commitment to making infrastructure spend here, and they're going to get funding from the domestic market, but they're also looking for foreign investors to commit to it too. So infrastructure, no doubt, at the state level and at the federal government level is going to continue to be a focus. It's just about finding the companies at the right valuation that are linked into that story for us as investors.
And I just want to understand from you, so what have you picked up with regards to the Indian infrastructure story? Because, we've been calling for capital for a very long time, right? And those commitments have not really come through. What are you seeing on the ground change? And there, may I also add that there are very few quality companies out there which have good execution capabilities, right? But the demand is significant.
Yeah.
So how do you bridge the gap, and what are you seeing on the ground change for your conviction to build in the sector and for you to get clients to invest?
Yeah, so I think that the infrastructure here is going to be built by a combination of foreign companies, and there are some domestic companies here that have good execution track records. So I think that you're going to get a combination of foreign financing. I think you'll get some local financing. I think there's a lot of banks that are going to be interested in providing financing to the infrastructure build out of India. And as long as it continues to be a priority stated by the federal and the central government, which is certainly what we heard when we were in Delhi, and that the states are focused on executing in it, I think that the capital will come and the resources will be deployed.
Right. So enough, you think, to take India's growth story to beyond 8%, or do you think 7.5% in this sort of a global environment is realistic?
Okay, so when we're in the U.S., we're happy to get 2.5%. So with you guys at 7.5%, I think that's quite good. And
but the bases are very different, right?
That's 100% true. But you know, in the 7 to 8% range is probably the right target, because of course, you know, if you get so much higher than that, you start to get inflation issues. I think it's, you know, the demographics would suggest that you can maintain that 7 to 8 growth % level for many years to come, and that's probably the right spot to be in. And on the back of that, you're going to create a lot of GDP, a lot of market cap, and hopefully a lot of wealth for people here.
Yeah, you know, Katie, you are here at a very interesting time. I'm sure you must be inundated with emails over the last 2 days because of what's happening in the U.S. Give us your sense.
Yes, it's been interesting to be here when U.S. markets have dislocated.
I thought you would take the next flight back home, but you're here, which is a sign, right?
It is absolutely a sign, because we're really focused on the long term, and this is absolutely part of our long-term strategy, emerging markets in India specifically. So what we've seen in the U.S., I think, is typical late cycle behavior. We're getting some normalization and volatility, and one might argue that needed to happen, and that's a good thing. And markets are jittery because they're worried about a rate rise. And why is there going to be a rate rise? There's going to be a rate rise because growth is good in the U.S., and with growth comes inflation, and with inflation, the central bank needs to act and raise rates. So I think you've seen people kind of trying to get their footing and repositioning, but I don't think it's a major crisis situation. I think we'll work our way through it. All of that being said, we continue to believe that some of the best opportunities in equity markets are actually outside of the U.S. We've been saying that for quite some time, and so we've been encouraging clients for the last few months to reduce U.S. exposure and allocate more internationally to both developed and emerging markets.
Because I told my viewers that your voice matters, and yours is the voice that they need to hear right now. Goldman Sachs has said that this is a correction. This is not the start of a bear market.
Right.
That's the conviction that you hold. You know, we might go down in the near term, but things will reverse soon.
Right. I would say, I think my colleagues on the sell side have put out some notes on that. And again, I would agree with that. Late cycle behavior, correction. We don't think that this is the start of a major bear market. We don't think that U.S. equity markets are in a bubble either. But, you know, again, we do see better relative opportunities for equities outside of the U.S.
But this is a super bull market, right? It's run 10 years.
360 some %. Yes, absolutely. So listen, but you use this term before, so I'm going to appropriate it again. It's the base, right? It's the base that you're coming from, and we came out of one of the greatest crises in financial history. So I would say this: sometimes people look at U.S. equity markets and they say, "Is this a bubble?" Because valuations are in the 99th percentile on most metrics, right? And so on the one hand, that's actually a little bit unnerving how expensive markets are. But then on the other hand, two things: one would be that growth continues to be good, and the second would be, while valuations are a necessary condition for a bubble, they're not the only condition. The other really important thing that you need is investor euphoria. And while, to your point, markets have run a lot, one thing that's interesting is if you look at retail flows into U.S. equity markets, they're actually 100 billion negative since the crisis. So while business sentiment is quite positive in the U.S., investor sentiment really never got to the point of euphoria. So I don't think we're at a bubble moment in the U.S. I think what we're seeing is a correction, and again, typical late cycle behavior. But the opportunities for us continue to be more outside of the U.S. than in the U.S.
Well, there you go. That's the big ET Now exclusive, the voice of the day that you'll continue to hear through the course of the market session today. Katie